Let's talk about investments and portfolio strategy. What kind of investments would you recommend for somebody like me?
This is always a good question.
Yeah.
And I feel like I'm a broken recorder every time I answer a question. So apologies there, but it just depends is ultimately where I was getting at. However, with that in mind, we take a goals-based approach to portfolio construction. So again, not starting with the portfolio, but really ending with the portfolio. Where we want our conversations to start is with the planning process and figuring out what your goals are for your money. Once we know what your goals are, we can start to align the portfolio to match those goals. The way we think about it, it's called the bucket approach. There's different ways to articulate it, but ultimately for us, it's short-term, intermediate, and long-term, or cash, income, and growth. Right? You align your portfolios using these different buckets to make sure that, again, you don't disrupt the compounding of your portfolio because of something that comes up in your life. We were talking about how much cash you need in an emergency fund. I'll just kind of extrapolate on that a little bit farther to articulate what our bucket approach really looks like. If you have 6 to 12 months of cash in a money market account or somewhere that's very stable, maybe it's your bank, then you know for certain that for the next 6 to 12 months, you have cash that's readily available either for your day-to-day living expenses or, again, for an emergency. Outside of that, you have income, right? For most folks who are working, their income is genuinely what they're making. It's the paycheck that they receive every 2 weeks. But for folks who are in retirement, the income might be the distribution that's coming off of the portfolio. That can be in the form of interest, dividends, capital gains, whatever that might look like. But that's really the income that's being derived from your portfolio. Some folks might know the 4% rule, but essentially if you have $1 million portfolio, utilizing the 4% rule means that we could take $40,000 a year from that $1 million portfolio and your money would last into perpetuity, right? So maybe the income portion is that 4% that's coming off the portfolio. The long-term bucket or the growth bucket are the funds that you don't need within the next decade. And the reason that we utilize a 10-year time frame is because historically speaking, over 10 years, the markets don't tend to show a negative performance over that time frame. Meaning that if you were to invest, in theory, at the top of the dot-com bubble, and 10 years passed, yes, your money wouldn't have grown any, but you also wouldn't have lost any or much at all, right? And so by utilizing these timeframes and focusing on the goals of our clients and lining the portfolio with those goals, we feel like, again, starting with planning, figuring out the goals, and then aligning the portfolio allows us to stick to whatever plan that we've outlined for the client